All right, let's go. Ed, man, kick us off, brother.
All right, what's up, everyone? Another Tuesday night, Multifamily Freedom Chasers, Underwriting Zoom. Glad to see you all here. I almost forgot what day of the week it was, but yeah. So, like I said, I plugged in our YouTube channel just so you guys have the ability to watch previous videos, catch this one again. As you guys can see, we're recording. So it's nice to see you all. There's a lot of new faces here. We filled up the room pretty quickly, so thank you guys. And looking forward to connecting with you all. If you all need anything, my contact's in my name. That's my Instagram and my phone number. Feel free to text me. I already got a text from one of you, so thank you. Cheers. And yeah, let's rock and roll.
All right, man, let's do it. All right, so here we like to keep it nice and tight. We're gonna be here for an hour, no more, no less. We're gonna cut it off at 9, and for that we have an agenda. We're gonna go over our intros. We're gonna tell you who we are. We're gonna ask about you. I see some new faces on here, so that's great. Hoping to get to learn about somebody new here. We'll go over our ecosystem and what that looks like, what it means, and then we'll get into our topic about other expenses as we're going through the underwriting process. And then we're gonna try to see if we can try to underwrite a deal just really quickly. So if you have a deal, let us know. Even if it's old, so you can go through the practice of, doing the quick napkin underwriting using this tool. And by the way, did you drop the tool as well, Ed, on there?
We'll do that right now.
Okay, perfect. This napkin underwriting tool is one that we've been using. Yeah, we created it together, and it's been super helpful to show you guys kind of how to quickly determine whether a deal is good or bad, and whether you should continue to pursue it more deeply. So with that, then we'll get into Q&A. But as always, you're welcome to just interrupt at any time, raise your hand, or interrupt Ed as he's talking about anything and ask questions. He does talk a lot, so interrupt him, please. With that said, who are we? Ed, tell us about you, man.
All right, guys. So as a lot of you know, I'm based out of Los Angeles. I'm a real estate agent, own a brokerage out here. And I love LA, don't plan to move here, but as the days go on, I find more reasons not to invest here. So with that being said, if you have any deals you're looking for help on, you want to work together on, you guys want to partner with, I'll just really quick say fun little story where through people in this community, through meeting other people because of people in this community, I have 120 units in escrow right now. And one of the people from our community here is on my team. So anyone here, like, you guys can, like, and I brought them on, I was like, hey, you do this, I need this, let's rock and roll. And now they're on my team, right? So it's really important to make sure that you're networking. So just to give you guys some background, 2 of the links I put here, real quick, I'll go over it. One is fill out the form, put your information in there, wait for people to contact you. The other one is where the information transfers to. And that's a way for you to touch base, meet other people in the community. And that's all it's about. Connect with everyone. You guys will find ways to work with each other, and you never know who knows who. So that's important. Keep in mind as well. But Aldo, take it away, introduce you. And I know Will's not here, but.
Yes, sir. Will do. Yeah, my partner in crime is missing on here, but I'll introduce us for sure. My name is Aldo and Ed, and my partner, Will Otis, and I started Stoic Holding Solutions about a year ago or so. We're originally and currently in the senior living space. We have collectively almost 25 years of experience in both operations and asset management in the senior living space, specifically assisted living, memory care, and independent living. And so we're just, a couple of freedom chasers out here trying to see if we can't break into the multifamily world using our expertise in senior living. And we're also not closed off to senior living either. And so there's a lot of that going around right now. So a little bit of a background about us. And so I deal a lot with underwriting, et cetera. So we'd love to come out here and teach and show you guys a little bit of the basics around how we can analyze deals. So with that, you're certainly welcome to contact any one of us, any 3 of us, if you have any questions around underwriting or anything else. My Instagram handle is on here, so is Ed's, and so is my phone number. Feel free to reach out. I would say Instagram is probably a little bit easier to get a hold of me, or text as well. So with that said, let's move on. Let's talk about you. So I see a lot of new faces, so I want to know, I want to hear from you. Let's tell us a little bit about you. If this is your first time on here, this is an opportunity for you to introduce yourself to this community, to tell us what you're doing, who you are, and make connections with people that you can potentially get into a deal with later on. As Ed pointed to a little bit earlier, if it hadn't been for this community, you probably wouldn't have connected with these people, right, Ed?
I don't have that deal. There's no, like, literally, it's impossible. Like, I don't.
Just saying, 120 units in escrow. That's
flying out there in 10 days, which is
hey,
cool.
let's go, man. Yeah, so definitely.
I'm spending my 30th birthday out there.
Oh, you're just a spring chicken, man. Yeah, if we don't hear from somebody, we're gonna volunteer somebody. So
okay, well, I think we have one who self-volunteered throughout the beginning of this call. Alright, give it a shot. Tell us who you are, what you're doing. You've already mentioned a little bit about what you're working on, but just give everyone a little bit of background about you.
Yes, I'm 22 years old. I started real estate when I was in college at 19, bought a single family house. In the last 2 years, I bought 220 units in Little Rock. And yeah, I love real estate.
Love that. Love that. This is Arkansas, Little Rock?
Yes, I buy strictly in Little Rock.
Oh, really? Nice. Great. Great to know your market. So what's your buy box, man?
I buy between like 40 to 70,000 a unit in Little Rock. That's pretty much like what I look for. And I look for high occupancy. I look for positive cash flow. I look for good areas in Little Rock. Yeah, that's kind of my buy box.
I love it. I love it. There it is, Ed. You know what to look for now.
I actually might know some people there. I don't know how, but I think I do.
They're probably Armenian. So. All right. Awesome. Hey, Arik. Is Arik?
Yes.
Sweet. It's nice to meet you, brother. Thanks for jumping on and for introducing yourself. Let's get one more. Let's get one more of you to introduce yourself and tell us about you. I see somebody off mute. I think you wanted to say something. I'm gonna butcher your name. I'm sorry.
Is that me or somebody else?
Oh, there's a couple of you. I'm gonna butcher their names, but go for it, man. You're off mute already. Go for it.
So I'll help you. So Sasha Marabi, just to help with the pronunciation.
Love it.
I'm in a full-time W-2, like I think many of you are, and have been pushing to get to financial independence, specifically with a focus on multifamily. So I'm a subject to and a multifamily strategy student with Cody and Christian. I've been focusing mostly on sort of 5 to 25 units, which is going well. I have nothing under contract yet, but what I'm realizing is after 1 or 2, I'm going to run out of funds and I'm not going to be able to scale. And so I'm here really learning how to go to the next level once I've got 1 or 2 under my belt and to do something bigger with other people. So that's why I'm here.
Bringing his hands.
This is my favorite topic. Oh man, where are you from originally?
Originally the UK, but I'm based up here in Seattle now.
Nice. Football fan?
No, which is really bad because I used to live in the old Arsenal stadium when I was in London.
Oh
but
no,
yeah.
no. You can't do that.
Terrible. I'm a bad Brit. I know.
It's okay.
I'm a bad
Brit.
Okay, you could be Manchester United fan. That's worse.
That's true. It's true.
Sorry, any United fans. I'm a Barcelona guy, but that's just me. Anyway, so one thing I want to touch on real quick, and as you guys can tell, give me anything to talk about and I won't shut up. But 5 to 25 units, is that in your backyard, or where are you looking at for that?
So combinate, yeah, my backyard here, but out east, east of Washington. And then also I've got family down in Florida, so I'm also looking down there as well.
Cool. So let's connect, because I have a lot of people in Florida, and I'm working on a few stuff there. So let's connect there about that. But in regards
Brilliant.
to the unit size,
Yep.
one thing is, if you're relying on your own money, it becomes very difficult to scale. So I'm always, me personally, because I'm not investing in Los Angeles, as I mentioned earlier, everything is far from me. It could be Little Rock, it could be North Florida, it could be South Florida, it could be all those backyard, or the backyard he's in now, which he's traveling for work, but it doesn't matter where it is. To me, if I have to get on a plane, it's far. Even Mario, who's in Vegas, I'm not driving to Vegas. There's no chance. So I will take a 45-minute flight. So my point is, focus on building the teams in the markets you personally want to invest in, and then the money will come with the team you build. I was part of a mentorship, spent a lot of time and money there. I'd rather have a piece of the watermelon than the whole grape. That's why I love working with teams. I'd rather work on 5 deals with multiple people and a large group and a team than work on one alone, or with 2 or 3 other people, right? Or 1 or 2 other people. So that's why we push so much to network with other people here, is because if someone has capital, they're really good at capital raising, and 25 units isn't enough, you need to up that. Because if you guys connect, all of a sudden they're like, okay, I love Florida, I have people there, I'm working on a 90 unit. If you tell me, hey, I have capital, some money, and I have people who have some money, and I have capital raisers who have more money, we put all of this together, and all of a sudden we're buying 90 units and not 15.
Yep, I'm very open to that. So yeah,
I love the idea of owning, because I think you learn the most doing it. And I'm never gonna tell anyone not to, because I've done it myself. Like my family and I, we have units here in LA, which is already crazy. But I always say, branch out to people and leverage your knowledge of specific markets, your resources in markets, and what you're good at. I always say that, because you'll be able to buy more and build more together than kind of limiting yourself to that 20 to or like 25 unit number. Because personally, then 120 is going to be easier than your 25. I promise. Because I have enough meat on the bone. I have enough capital to hire a property management company, to have the right people in place where I don't have to be there and supervising it at all times. Are we going to? Yeah, we're going to be very hands-on, but I have money where I could stretch it and outsource a lot of my costs, essentially, and responsibilities, to be fair.
No, it makes complete sense. Thank you. And I think if anyone's interested in connecting and you're focused in Florida, then please do. My Instagram handle is at the top as well. So
my name's there. Text me. We'll connect, because I have a lot of stuff going on in Florida.
Awesome. I will do. Thanks, Ed.
Nice to meet you. Very nice to meet you.
You too. Thank you both.
Thank you, Sasha. I appreciate you jumping on and introducing yourself. And you're definitely doing the right thing by connecting with communities. And this is where you find all those things: the capital, the team potentially, and all that. So thanks for jumping on and telling us about you. All right, with that, let's go on. We've talked about the journey in the past, and this is the way that we want to frame this story, and the way that we want to frame this entire ecosystem for you guys. You know what a journey looks like for most people, for somebody, right? So it's three separate paths you can take with this. You can learn all about all that we're doing here with all this free content. You can say no thanks. Appreciate the education, it's free, love that, but it's not for me, and that's absolutely okay. You should find what is for you. The second path is, you know what, I love all of this real estate stuff, but I'm not sure I want to be an operator. I want to be a passive investor, right? So hey, welcome to the club. It's also really good for you as a passive investor to know and understand the ins and outs and the complexities of multifamily real estate investing, so that you can make wise decisions as you invest. And so it's important for you to be in a community that shows you all of those complexities and intricacies. So great. And then if you choose to be, you see everything that we show you here, and you're excited about it, and you say, I want to be an active operator, I want to be in day-to-day on here because I love multifamily. Awesome. Listen, we'll get you started. This is the starting point for you guys. but we know we have a lot of connections with different mentorships and people that can take you to the next level, and people that have invested, into these sort of mentorships, et cetera. They're always, I haven't personally, but have a lot of background in this, but people that have invested in this are saying, hey, I've accelerated my success just by being in these. So you're essentially paying for the results, a lot quicker to come. So you're either gonna pay in like blood, sweat, and tears and a ton of mistakes, or you're gonna pay a little bit of cash up front and be able to, accelerate your success. So you choose what you want to do and how you want to do it. What we're here to do is to give you a good base of free education and then connect you with people that could potentially take you to the next level should you choose. Now, all these people we have vetted, and so we're giving you access to different programs that we vet and that we would be comfortable taking ourselves and recommending to you, because we have a reputation to protect as well as the Freedom Chasers. So those are the 3 journeys you can take as a Freedom Chaser. And
Real quick, let me add something real quick before you play that.
Yeah.
The YouTube channel I posted earlier that I just posted again, a lot of these people, and I think almost all of them, but don't quote me on that, were a guest on the Sunday calls.
Yes.
So you can see their story, you can hear them interact with Marcel, Trevor, and Victor, and you can get an idea of what they're all about before. Like, these are trusted. Like, we don't put them on this platform and give them this opportunity as much as we give you guys if we didn't try and test what they're actually trying to help you out with. So just a little background as well, so you can check out their episodes on the YouTube channel, which
Absolutely.
we hit 500 subscribers, which I think is cool because I didn't know we were that close. So
How many?
500.
Oh,
So,
let's go.
That's pretty cool.
Sweet. Now a message from one of our core multifamily chaser Freedom Boys. So
Multifamily Freedom Chasers family, I have exciting news for you all. We are launching our Preferred Partners program for the community. You as a community member, as a Freedom Chaser, have access to this right now for free. So what is the Preferred Partners program? It is a program designed when you are ready to accelerate your multifamily real estate journey, you are ready to invest in yourself, to level up your education and business building experience. This is the place to go. These are the partners and resources that we have invested into and we use hands-on that have helped us level up in our multifamily journey. So pretty cool. Our preferred partners that are part of this list, it continues to grow, but right now they have over $2 billion of assets under management. Super cool. High-level teams and high-level operating individuals. So let me walk you through this here really quickly. We have Gabe Bowling's real estate training, Mastering Multifamily with Vina Jetty with her educational vault, Rockstar Capital and Robert Martinez, they have several different educational options. If you need mindset and performance coaching, we got Keston Glasgow with Purpose Ways. The Mary Machine, website, funnels, marketing, everything you need there. Self-directed retirement services with Horizon Trust, CRM, an underwriting multifamily course with Ken Gee himself. And then if you don't have the funding, but you're ready to accelerate your multifamily journey and invest in yourself and invest in your business, we have DC Global Enterprises where you can get no interest funding to fund those type of investments. So take advantage of the Preferred Partners program of the Multifamily Freedom Chasers, and let's continue our chase for freedom together.
Oh, yes, sir. All right. With that said, you guys know and understand the whole ecosystem, where we have our Sunday activation Zoom, broker talks last night with Ed and Pete. And then of course tonight we have Napkin Underwriting with alternating Wednesdays having the Miles family talking about the debt market, and then every other Wednesday on alternating nights at 8:30 p.m. we'll have the multifamily foundations with Armada REI, and they're just going to be going through a lot of the just foundational things about and basics of multifamily real estate investing. So with all that said, this is how you can contact us. And now I think it's time for us to get into our topic of choice, which is very important.
With how many new people we have, this is very ironic because I don't think a lot of people were here for the first expense call. So this will be interesting.
I mean, we can always go through the whole thing again. So, you know, we got to
Just volunteer me.
yeah, always volunteer.
I'm kidding.
No, so hey guys, so expenses, right? So there's and the reason we're going to do other expenses today is because there's different types of expenses when it comes to multifamily real estate investing, and they play a different role in, say, you know, even valuation, taxes, and different, I guess, impacts that they can have on your business in general. So, you know, there's what we call operating expenses, right? And there's non-operating expenses. And then there are items that sit below the line, which are also non-operating, but they also don't count towards your net operating income. These are, of course, accounting things and accounting principles, in the way that it is, you know, the accounting principles are set up so that you can take some of these expenses and use them in your favor to minimize your tax burden, etc., and to increase your cash flow because of that, you know, minimization of your tax burden. But this is not an accounting lesson. This is a quick lesson on expenses. So we've gone through our revenue, right? And on a very basic level, the three major components of a profit and loss statement or an income statement are revenue, all the money that's coming in, your expenses that it takes to operate the community, that's a senior living term, to operate the building or the asset, and then your net operating income, right? And so the net operating income is very important because it's not your final cash flow. It's not your final net income, right? But this net operating income is the income that is used to valuate your asset, right? So it's very, very important that we do everything that we can to maximize this net operating income. So we've talked about revenue and how to maximize that revenue. And then from an expense standpoint, we need to talk about understanding all of your expenses and then tweaking those expenses so that we can bring it to, you know, the minimum that we can while still providing great services to our tenants, right? And so just to be good stewards of the money that we have there. And so if you increase your revenue and decrease your expenses, your NOI or net operating income goes up. And when that goes up, your value goes up exponentially, right? And so we've heard it said before, at a 5 cap, and we can get into cap rates and what that means later on, at a 5% cap rate, every dollar of NOI that you increase turns into $20 of valuation. So if you buy a building for $20, or sorry, $1, let's say, and you add another $1 of NOI, you've just increased the value of your property by $20. And guess what? At the very end, when you sell it, I mean, that's money in your pocket and the pocket of your investors, right? Of course, Uncle Sam, and it depends on how you do that, Uncle Sam may take the portion of that. But that's why it's really important to understand. It said nope, not with a cost segregated whatchamacallit, depreciation schedule on there, and maybe one day we can get into that. So because there are such things as ghost expenses, but maybe we won't get into that today. But you know, your general operating expenses are just going to be all those things that it takes to operate your building. And typically they start with, like, you know, administrative, but we can just follow this. This is a profit and loss statement from an old deal. And you can see all the expense side from here all the way down. And, you know, you look at salaries that you pay to the people that work here, whether it's, you know, your maintenance person, your property management, your property manager, if you have one, your administrator,
On-site manager.
on-site man. Yes, thank you. Your on-site manager, if you have a salesperson, it's coming out of here. If you have, if you're paying, if you have a leasing office, the water, the electric is coming out of there. Any kind of landscaping contracts, and you can see that all in here. Maintenance probably takes the bulk of a lot of these, because it includes your utilities, it includes any contract like your landscaper, your trash people, anything that it takes to run this building on a day-to-day is going to fall under your operating expenses, right? What other things are on here? Admin expenses, like, so if you have a leasing office on there, then you're paying for paper, your copier contract, the telephone bill, et cetera, et cetera, et cetera, et cetera, right? There's so many different things that fall on into here, right? If you have to pay for marketing, like if you advertise on, not Yellow Pages anymore, on Yelp, or if you advertise on apartments.com, or if you advertise on Zillow, wherever it is that you advertise, that's coming out of here as well. Insurance comes out of here. What else comes out of here, Ed? Yeah.
So one thing I want to mention on this too is, remember, and this is very important when you're looking to acquire and underwrite a deal, this is what their expenses are today.
Yes.
Your insurance can possibly change and will most likely change. You also want to know, when was that insurance signed, because it will eventually expire and you'll have to renew. And for all the noise we talked about, and for all the people who are in Florida, you guys know this as much as I do because I'm dealing with it now. Insurance sucks over there. It's tough, right? It's very expensive. Remember, another thing, knowing your market, the taxes, and at least in how it is here in California, it gets reassessed at the point of refinance or sale. Not every state is like that. Sometimes they do it on a schedule every couple years. Sometimes they do it at time of purchase. Sometimes they do it time of refinance. Sometimes they do when they feel like it. Your tax is most likely going to change when you acquire the property, especially because there's going to be a change in ownership. It's an opportunity for the city to capitalize. They're not going to miss an opportunity to raise taxes, right? But every market's different. Make sure you know your market and what those rules and rule of thumbs are, right? The last thing you want is to underwrite a deal, everything looks great, and then all of a sudden, oops, tax tripled, insurance tripled, whatever it is, right? How do you account for adjusting insurance rates? So the best way you can do, Daryl, great question in the chat, but the best way you can do it is find out what their quote is, shop around and get comfortable with knowing what quotes in the area are. And for example, I'm just using Florida because it's the easiest for me since I have one I'm working on there. Knowing how previous natural disasters may have impacted the rates. Is this area in a flood zone? Is it not? Has this been impacted previously? Has it not? Or there, sometimes the building is a large factor. Think of it like you get insurance for yourself. If you're healthy, fit, and don't have any issues, it's going to cost less. If you have some issues that are prior issues, it's going to cost more. Bottom line, that's just the reality of it. Buildings, the same thing. If you don't have new roof, you don't have new windows that, or a structure or foundation that makes it safer and can handle more wear and tear or whatever it is, your insurance is going to cost more. And there are states, and I know Florida does this, where if you don't have XYZ on a building, your insurance automatically is going to be a lot more.
So in short, make sure you get a good quote from a broker. And
you're building a network. Any market you're in, you're building a team, property managers, contractors, people that are going to rehab your property, inspection company, to lawyers, because someone's writing up the contract, someone's putting together all the documents for you, and making sure you're on the, like, everything is airtight. Insurance agents, shop everything around. Don't ever get one quote. At least 3 to 5 quotes on every single thing you do, unless you have someone there you just really know, like you personally know there and you trust them and you work with them, then by all means, like, go for it. But if you're not, you definitely need to make sure you dot your I's and cross your T's.
Right. And so these are all expenses that take place, and they feed into into your operations expenses, right? And so there are those expenses that are directly tied to the operation of the asset, and then there are expenses that are not tied directly to the operations of the asset, but still sit above the line. And what the line is so these are your revenue, this is your expenses, and this is your NOI down here. Anything above NOI is the line. NOI is the line, right? And so, and that matters, and we can get into that later. But so there are those expenses that it takes to operate, and there are some expenses that it takes that are above NOI that are not directly tied to operations. For example, legal fees. That's not tied to operating your asset. Management fees, if you're paying for those are non-operating assets that still sit above the line. You know, things even taxes and insurance, those are non-operating that you need to pay for. And to Ed's point, you need to really familiarize yourself with, you know, knowing and understanding how much those expenses are going to increase by, because I tell you right now, a broker may be selling an asset at call it a 6 cap, right? But the second that you sell that building, your taxes are going to go up. Very, very likely that they're going to go up. And that means that it just went just like that, from a 6 cap, maybe down to a 5.5 cap or a 5 cap immediately, right? And so it's up to you to then push the rates, push the revenue, you know, get real, you know, tight on your expenses and drive up NOI, so that one, you make up for that loss of NOI, but then also continue to drive the asset towards success into the future. So it's very important to know and understand where expenses could go, right? And then, of course, there are expenses that sit below NOI, and those are things like asset management fees. Those things can go below the line, or you know, they're allowed to go below the line. Any kind of capital expenditure costs, that goes below the line. What is a capital expenditure? Well, you know, the law around that, you know, you can get pretty gray about it, but essentially it's any kind of improvement that you do to the building that extends the useful life of the building, or something around the building, like an AC unit. If you replace it with a new one, that's extending the life, so you can capitalize that. And what does that mean? Well, it doesn't hit your NOI, right? It doesn't hit your NOI. And in fact, those expenses don't go into your profit and loss statement. What you're doing is essentially you're setting aside cash for your capital expenditure. So you would have a CapEx reserve, right? And you say you know, you do like $10,000 a year, let's just say. So you're just putting that as a placeholder on there because you're taking away cash. That all sits in your balance sheet. Now, I'm talking a lot about accounting terms here, but my point here is that these are real cash outflow expenses that don't necessarily reveal themselves on your profit and loss statement, which is what is used to evaluate your asset, right? And so and the reason I say that is because when you're purchasing an asset, it is very, very important to know and understand what kind of capital infusion your asset is going to need, so that it can operate to the level that you're projecting that it's going to operate. So if I buy a building right now and it's, you know, a C class, and I want to bring it up to a C plus so that I can, you know, increase my rents, or even a B in a B area, and I want to do that so that I can increase my rents, well, that means I'm going to need to put in $5,000, $10,000, maybe $12,000 per unit. Well, that all is going to have to come out of somewhere, and that is a cash outflow. So I need to understand that as a cost, right? It may not be in here, anywhere in here, but it is an actual cost, and it is going to affect your cash flow. It's going to affect your returns to your investors as well. So that's one part of the other expenses. That's the other expense thing that I was talking about earlier that is going to affect your returns. So not only are there the operational expenses, but then there are other things that are what we call ghost expenses on there that are going to affect your cash flow. Now, having said all of that, you know, the IRS does give a provision for you to be able to minimize your tax burden, using, cost-segregated depreciation and, tax interest, not tax interest, mortgage interest expense, etc. But that's a topic for another day. You can really minimize your tax impact with that. So anyway, recap: revenue, operating and non-operating expenses that sit above the line, NOI, and then there are some other expenses below the line, to which it gives you, which includes your mortgage payment, by the way. Your mortgage payment sits below the line, which then gives you your total cash flow minus all of those things, right? So this is cash flow down here after some of these below line items, and then you have NOI here, right? This is the one you want to focus on for the valuation standpoint, and the cash flow is obviously one you want to focus on so that you can show good returns to your investors. All right, with that, do we have any questions?
I want to add something real quick, especially when it comes to expenses, when you're running through an analysis, you're running through a doc like this. For example, look at the water and sewer on line 89. Look out for large inconsistencies such as that, because those are great questions and things that you're going to have to address. And not only do knowing these expenses help you in your underwriting and things you may change or improve on, or areas of opportunities, to Aldo's point earlier, every dollar you can almost multiply by 20 in the return you get on the investment. So sometimes people buy buildings just to lower the expenses and they resell it. It's literally that simple. It's not rocket science, right? But also, more importantly, you can't acquire a building unless you have a understanding of what the T12 itemized expenses are and being able to explain to a lender. If you're getting new debt, the lender doesn't care if you underwrote it. They don't care what your offer is. They care, can you explain what these are, what these line items are, what's the projection, and how you're going to make this investment, that they are investing in you as well. Remember that. This isn't just like, you're not getting this money just because like they like you. Like it literally has to make sense. And they're gonna be your best friend in regards to making sure you don't invest in a bad deal, but they're gonna ask the most questions. It's right, very important to understand that anything like this, and for a lot of people who were on yesterday's call with the broker talk, stuff like this is great areas to question a broker and control the conversation. Because it allows you to say, hey, I noticed XYZ. It didn't take long. I can barely see the screen right now, and I noticed I caught that 50,000 expense. Like you just go through, you look for any inconsistencies. I usually start with the big cost, big ticket items, and then I look for other stuff. But right away, you notice like, okay, why is that so high? What happened? Right? So that's very important to understand that. So it's very important to make sure that you're double checking what those discrepancies may be, finding out what those are, and maybe that is an opportunity that you can say, hey, if they're expecting XYZ or they're not doing this well, great. It's an area we could come in and save some money, right? Or run it better, So it's really important to keep that in mind. When you're going through the expense, you're not only going through it to understand what the current building looks like, it's to identify more opportunity in the future. It goes both ways. So keep that in mind.
Super well said. Thanks, Ed. All right. Any questions before we move on to napkin underwriting? All right. Let's see. I think Jabs, you had a deal on here. Can we get the template? Yeah.
I'll put it in. I got it.
Yeah, absolutely. So let's see if we can't get this on here.
All right, so that's the napkin, guys. You're not able to edit it, obviously, because that's our master copy. But what you're able to do is just make a copy for yourself. One thing I recommend, I made this mistake early on and I wasted a lot of time. Every time you are underwriting a deal, whether it's napkin or further underwriting, create a copy with that property address and as much
Yep.
information as you can, so that if it ever resurfaces, or if you need to refer back to it, you have it saved and you know where to find it. I have underwritten multiple deals multiple times, and more times than I like to admit, because I lost a document. Not proud to say it, but I'm just warning you guys so you don't make the same mistake.
Yeah, great point. I have a graveyard just like yours.
I filled the Google Drive. I didn't even know that was possible.
All right, Jabs, I'm gonna get to yours here. Yep, got that link. So we're looking at, was it 38 units, I think? 38 units. So let's put that in here. Maybe we'll need to go over this tool again at some point. We see a lot of new people here. All right, 38 units, and trying to find what the average rates are here. Do you have any idea about that? Here we go, historical rents, rent roll. So, important information you'll need for this is obviously, unit count. You need an average, you need an average rent. So a weighted average, not like your three, you have to say 1 and 2 and 3 bedrooms, not those averaged out. It has to be a weighted average. So basically, if you have 10, 10, and 10 of each, you have to multiply each rate by the amount and then divide it by the total of that. Now, this tool right here helps you do that. If you don't have that off the bat, this side, you just put in the number of units, you put in the rent for that unit type, and then at the end here, it gives you a weighted average, which is what you want. All right. Alternatively, you can just go to the rent roll and you take the total total monthly rent that you're collecting. Like, for example, this one I think is $31,995, and you divide it by the current occupancy. So this one's got 38 minus 1, 2, 3, 4 vacants. So you do 31,955 divided by 34. And that's 939. Let's call it $940 per unit. Yes, the tool can be shared with you. So Ed just posted it up there. If you want to drop it again, Ed, that'd be cool too. So so all you have to do is just make a copy of this tool so then you can use it. All right, so we have $940 average rent, total units 38. We need to know what its occupancy is. So you need to know the occupancy as well. All right. Immediate renters, loan assumption, blah, blah. Oh, I have it. Hello. 34 divided by 38. 89%. Let's call it 90%. We'll round it up to 90%. Okay, so anything in blue is an input. Everything else is a formula. Okay. So everything in blue. So we have $940 average rent for 38 units at an occupancy of 90%. Our total income just on rents is going to be $385,000, right? Almost $386,000. Great. What next? Well, we have to kind of guess, make an educated guess about the expense ratio, right? So 50% of that we assume, let's say, is going to be expenses. Why do I say let's see? Well, there are some rules of thumb around expense ratios, and an expense ratio is just, what percentage of your revenue is your expense, basically, right? And for the most part, and there's a ton of data around this, and if you ask any lender and they'll send you their data, for a C class in most markets, you're looking at around 50, maybe even more actually, expense ratio. So for $385,000 in revenue, 50% of that is likely going to be your expenses. Now, I'm not saying that there aren't assets that are running below that or even above that, but this is the average, right? And especially if the utilities are paid directly by the tenant, this could be lower. This could be 45, 48.
But let me
But-
jump in real quick. Let me
All
jump
right.
in real quick.
All right.
On any document, T12, whatever it is, even if utilities are being paid by the tenants, there's rubs, there's something involved like that, you want to make sure that the initial document has the utility cost in there, unless it's not billed to you and you don't know it. That's a different story. But
Correct. Like if it's paid directly by the tenant.
correct. But if it's like something with a bill back, where you receive the bill, you pay for it, and then you get reimbursement on it, then you have to create an additional income slot for that money. Why? Because one, it's not always going to be the full amount. And most of the times it's not. You're not even allowed to do the full amount. Also, if you have higher vacancy or whatever the case is, or you have other utility costs, such as your leasing office has power, you still use water and power there. You have a gym that uses water and power. You have landscaping that uses water. You have whatever the case is, XYZ. You need to make sure those costs are all tracked and accounted for, and not just, oh, the tenant pays for us back for it, I don't need to put it in the docs or
Right.
in my accounting. It's very important that you understand, if they're not there, make sure you know why,
Right.
and make sure you're asking those questions, because something slips through the cracks. It's a lot higher than it should be. And yeah, there you go. Roy said it. You have utilities when it's empty. That's true. Like, it's still there. You know, someone's responsible.
Yeah.
So that's why I think it is important that you always find some form of utility expense on a T12.
Correct. Correct. And you make a good distinction. I guess what I was saying is if the tenant pays for it directly, that won't be a direct. Now, you might have still some utilities if you have a leasing office or you have some outside street lights. So there may be some of that. But generally speaking, on average, expenses run about 50% for a C class, same for a B class, and about 45% for an A class asset, right? So with that information, we gather an NOI, $192,000. That's what we gather from that, right? Now, what do we do with this information? Okay. What you need in order to determine whether, this is a good deal to pursue or not is obviously the asking price or the guidance price or the whisper price, as they say it. So, Jazz, I'm going to try to see if this is, if I can see that here, but, oh, here it is, acquisition price. Acquisition price being 2.75 million. So, all right. So now I have the price on here. That's 200 and, is that right? That ain't right. Something's off here. Valuation. Oh no, that's the price. Okay. All right, never mind. Okay. So what we're trying to gather here is what's called the going in cap rate, or the cap rate at purchase here, right? So with the calculation that we just made and with the assumption of expense ratios that we just made, what this is telling us is that we're currently sitting at this price at $2.75 million. This is coming out to be a 7% cap rate, which is not bad at all. What does that mean? What is a cap rate? Really quick, another recap on what a cap rate is. The cap rate is the capitalization rate, which means that it is the unlevered return. So the returns, if you were to buy this cash, what that would be. So if I were to buy this at $2.75 million, my returns on that cash would be 7%, because I don't have to worry about paying a mortgage, etc. Right? That would be my cash flow directly. All right. So a cap rate at purchase of 7% is really good. I would say most people are trying to get like 5 to 6, if that, maybe less.
Depends on your market. Something to keep in mind. When we say know your market, that's a big reason too.
Sure, absolutely, absolutely. But I have not seen any market, when I put
Yeah.
in underwriting, it's coming out at 7%.
100%.
So, there's definitely, I would say this is just from this, I would say this is worth exploring further for me. And that's what this tool is. Is this worth exploring for me? Right. And so, another thing to really look at here is what is the market, since you brought that up. Let's see. The market, it looks like Houston. Yep. I mean, I would say a 7 cap in Houston is amazing. Yep. I mean, I would buy this yesterday probably. So okay, so this is the initial part of this calculator, right? Then there's an exit part. Jabs, are they telling you kind of what you can drive rents to? Well, I guess we can have that on the rent roll and even see what the market rates are on here. Not really very much more. Let's see. 1100. Okay, 1,000 to 1,100. Great. So let's call it 1,100. %. So you bring it up to 95%. I wonder what the long-term occupancy average is in this area. It probably can't be any less than 90%. Let's put it at 90%. Just keep it even. Okay. Another part of this that we need to look at is what the exit cap rate is going to be, right? And so part of multifamily real estate is guessing how much your deal is going to be in the future when you refi or sell it, right? And so it's a little bit of crystal balling. So you can get your exit cap rate from your brokers, from your debt brokers, from oh man, it's been so long. What is that website, man? That software. It's not Crexy. It's man, it's huge. What am I doing?
LoopNet?
No, it's like where you get all your data from, like average occupancies, new builds and
CoStar?
Marcus and Millichap?
CoStar. Thank you.
CoStar.
Oh my gosh, I totally brain farted. CoStar. Although Marcus and Millichap, I think they have a pretty decent one themselves. So anyway, you can get that from them. Now, what most people do when they're underwriting is well, this was traditionally before this incredible explosion, right? So a lot of people what they were doing is underwriting, 10 basis points per year of holding the asset. So if you're going to hold it for 5 years, you would schedule a 5 or 0.5% or a 50 basis point increase on your purchase cap rate. So you would go from 7.1 to 7.5, say, just to be conservative on your exit, in case anything were to happen. Because if your cap rate expands and you were not expecting for it to expand, what happens is that you overshot your valuation by however much it expanded over what you thought it was going to be, right? So, even if it's a 0.5%, I mean, you can, depending on the unit size on this, I mean, you can be talking about hundreds of thousands of dollars, if not millions, off in valuation if you get this wrong. So I would always err on the side of caution and make sure that your deal works, even if the market causes the cap rates to expand. Okay. With that said, what I'm trying to get at here is on exit or on stabilization, if we can get our rents to $1,100 at 90%, at 50% expense ratio, then we can get an NOI of $225,000. So we went up, right, from 192 to 225. That's good, right? It means our valuation went up. And so even with an expanded cap rate after 5 years, we're seeing an upside of almost $260,000, right, on that. And on a 38 unit, it's not terrible. I'd probably want to see a little bit more on that expansion, but I'm not sure you can ask too much of, 38 units. So that's something else to look at as you're underwriting this. So, okay, I'm seeing an initial at purchase cap rate of 7%. All right, that's super intriguing. Let's explore that a little bit further. All right, so if I were to sell this, what's my upside? Okay, 260. Could we get it to 500,000 on this size? Okay, maybe we can talk around that. And then, of course, the biggest component to this is going to be your debt, right? And so I don't know where 5.25%, was doing on here. This was maybe underwritten like 20 years ago, but I think where are we sitting at right now? 7? Is it 7 yet?
I'll give it probably a little more than that, but yeah.
Let's put 7.25. I don't know. Did Jerry say anything yesterday?
I'm not sure.
All right. Someone's asking, what's the 9.44%? Let's see, where are we with that?
Under the upside.
Oh, okay. So basically, yeah. Yeah, the upside is, actually, I should take that out. Essentially, the percentage increase over your purchase price. So that's a 10%, basically your return on that. Just on that. Now, that doesn't, this upside does not include your cash flow, any other fees that you charge, etc. So it goes into that and it helps to calculate the internal rate of return, but not the cash on cash return. So this is just one portion of the returns that you would look at, right? And so, what was he going to say? Okay, so one thing, well, let's call it 6.75. Let's just, just say that. So for example, when looking at a deal, you want to try to make sure that when you buy an asset and your going in rate, not necessarily your cap rate at purchase, but your going in cap rate, which is your cap rate after year 1 of operation, you want to make sure that that cap rate is higher than your interest rate. Okay, you want to make sure that because if the opposite happens, it's called being negatively leveraged, right? And so these percentages can be a little bit confusing because they act almost opposite in opposites, right? So the higher that your cap rate is, or the lower that your cap rate is, it means that the more value your property has, right? Or the less return it has on the price based on that price that you paid for it, right? And so so for example, in this example, your cap rate is sitting at 7 going at purchase, which means that on year 1, let's say that we can bring that up to 1,000, right? We're looking at a going in cap rate after year 1 of 4.4. Let's call it 7.5% on the cap rate. Well, okay, good. So now we have a really good cushion between what I'm paying in interest rate and what my going in cap rate was. So that means that not only am I able to cover my mortgage, but I'm also going to be able to cash flow on that same deal. Because if your cap rate is below your interest rate, it's likely that you may not be able to cash flow, and it's likely that you'll just have a really razor thin margin between your NOI and your interest rate or your mortgage payment, right? And so that's what's called being negatively leveraged. It's not a really good place to be. Let's see, somebody else has a question. Why does a lower return on your capital equate to more, what's it say? To more value. So it's not a lower return on your capital. A lower cap rate, because it's an inverse relation with your cap rate. So for example, when you buy something, when you buy an asset, you want the purchase cap rate to be high, right? Because that's the return. But when you sell something, you want your cap rate to be low. You want your cap rate to be lower so that it can be valued at more. So because this is the equation to value to know what the value of your property is. NOI divided by the cap rate, right? And by cap rate, so here's another term to confuse you more. The market cap rate. essentially, right? And so there's such a thing as a purchase and sale cap rate, and then there's a market cap rate, which is driven by essentially the history of cap rates in that area of how things have been sold in the past, right? So you take that cap rate and you plug it into your NOI, and it gives you your valuation, right? And so you can figure, let's say that my NOI is $100,000. Let's just say that my NOI is $100,000 a year, let's say, and the market cap rate is, call it 6%. So I'm going to take $100,000 and divide it by 6%. That gives me a value of $1.66 million, right? So maybe I bought it at a 7 cap. Let's do 100. Let's say that the NOI stayed exactly the same. You can do $100,000 in NOI. You divide it by 0.07. That's $1.4 million, right? So you can see how on the same NOI, the cap rate acts inversely to the value. So the lower the cap rate, the higher the valuation. The higher the cap rate, the lower the evaluation. Even though that in the inverse, when you're purchasing it, it acts differently. So that if you have a higher cap rate on this, it means that your returns on that purchase are higher. And maybe we can have another class on cap rates and how they work on here, because I know it can be a little intense. I understand the phone method. It just doesn't make sense. I get it. If I can get a higher return on, well, it's not a return on capital necessarily. So I mean, it is. So if you buy something, see, I'm just going to finish reading the question. If I would think that it would be more valuable to me as an investor. So yeah, so it's more valuable to you as an investor when you purchase something at a higher rate, at a higher cap rate. It is more valuable to you if you purchase. So you want to purchase at a higher cap rate. But when you go to sell, you want to sell at as low a cap rate as you possibly can, because it shoots up the value of your property, right? So that maybe you're essentially selling it at a lower unleveraged return for the next person buying it, right? And a lot of that is determined by the market. You can't really do a whole lot with the cap rate. So yeah, that's correct. That's correct, Ashley. That's exactly right. So man, we're having a lot of fun around this, but it is 9:08. We have gone over that. So anyway, yeah, no, it was a really good question around cap rates. And I think, maybe we can just have a special one on cap rates maybe next time, and just kind of dive a little bit deeper into what a cap rate is and how it affects, everything. So why the cap rate is 7 and exit is higher. Yeah, so good question. You do that so that you can hedge your risk as an operator, right? So like I was saying, a lot of people, when they underwrite a deal, they put down an exit cap rate of at least 1 basis point per year of ownership, right? So in this case, if we bought it at a 7 cap, we're going to sell it at a 7.5 cap. We're going to underwrite it to sell at a 7.5 cap, right? So that everything else that we do, if it still makes sense at that point, it is a good buy. Now, you can underwrite whatever you want on here. I would just not do that. I would recommend that you kind of stick to, a more traditional underwriting philosophy on this. You can go ham on this if you want. You can underwrite a 5% exit and get this giant return. But I guarantee you, if you're a sophisticated investor and you're looking at this and saying, I would ask you, hey, why are you underwriting a lower cap rate on this, right? I would say no, because something like last year could happen, right? Interest rates go up and it pushes cap rates way up as well. And all of a sudden you're losing all kinds of value on your asset. But if you had a little bit of foresight, or at least a little bit of risk aversion, or risk mitigation, you could have avoided some value drop on that. So anyway, This is fun. This is fun. Yeah, so I said try to sell it as low as possible. So there's a difference between underwriting it and then actually selling it, right? So I'm going to underwrite it at that, 1 or maybe 50 basis points, right? Just to make sure that I'm hedging myself, but I'm going to try to sell it at the current market cap rate, or maybe even lower if I can, right? Yeah, so it's a valid point. Is 0.5% conservative enough? Some people are thinking it's not in this environment. Some people are doing a whole point, 100 points. So yeah, that's a valid concern. My advice in general is try to underwrite a higher exit cap rate, period. Now it's going to depend on your market, on the timing of the market, where we are in the cycle, etc. So with that said, guys, this was a lot of fun. This was awesome. Please feel free to reach out to us if you have any questions. Join us next week again as we talk more, try to see if we can cover the cap rates in more depth. But also join us tomorrow. Is it Armada tomorrow, Ed, or is it the Miles?
Is the new one tomorrow or Thursday?
I thought it was Wednesday. Anyway,
It might
join
be
us tomorrow.
Yeah,